We mentioned the significant reversal in bond yields in the third quarter of 19, but do not get accustomed to these types of returns in your fixed income portfolio. Keep in mind that interest rates are driven by a lot of different factors. One of them is global policy, and we talked about how global central banks were easing monetary policy. Some of them are easing them so much that we have negative interest rates. In fact, there's about $15 trillion worth of negative yielding global bond debt out there. So this is having an impact on all global bond yields. But the other things that drive interest rates are really growth and inflation. Right now, we have a very muted inflation environment, and we just finished telling you about how growth is slowing. So you would expect to see some modest decline in interest rates. If you look at the next chart, this shows you the leading indicator index and how that is moving on a year-over-year basis. And you overlay that with the 10-year bond yield. And what you tend to see is that as leading indicators are coming down, bond yields come down. But the most important takeaway from this chart is that you do tend to see a reversal, and those reversals can happen quite quickly and leave long-term bond investors with a significant amount of interest rate risk. So as a whole, the entire fixed income asset class is expensive. However, in these highly dynamic and uncertain economic times, it does make sense to have fixed income exposure in your portfolios. It can serve as a diversifier and even a hedge, especially if growth does weaken further. But with that being said, our focus would be specifically in those short, very intermediate maturing bonds. These will help mitigate interest rate risk as interest rates normalize. When it comes to credit, we still think at this stage of the credit and economic cycle, you don't want to sacrifice quality for yield. High yield right now, that extra yield you're earning over treasuries is not giving you the reward for the extra risk that you're taking. So we would focus on investment grade over high yield. We also like emerging market bonds that can offer you not only diversification, but extra yield. But again, within fixed income, stay short to that very intermediate maturity range as to mitigate some of that interest rate risk.